Good afternoon, everyone. My name is Mark Johnson, and I'm Managing Director of Rates within the ATB Capital Markets Group. And I'm coming to you today to talk about the Bank of Canada's decision to cut rates this morning by another 25 basis points down to 2.75%. And just like last month, these are extraordinary times and they demand extraordinary coverage. And so I've invited along again our friend Mark Parsons, Chief Economist Mark Parsons from ATB Financial, to discuss this with me. We got so much fan mail from the last one that we thought we'd bring the band back together. So good afternoon, Mark. How are you?
I'm great. How are you, Mark?
Not too bad, thank you. So we got another cut. From the market's perspective, broadly priced in, it was 23 basis points, I think, was where we were at going in. So no great surprise there. What are your thoughts on what the Bank of Canada delivered today?
Yeah, not surprised at all. And actually, I thought the Bank of Canada stick handled this really well. They came out with a forecast earlier in the year in the January NPR. Didn't really have a lot of with tariffs. They didn't really say this is what's going to happen, but they've come out later with more analysis on what this could do to the Canadian economy. Through February, Tiff Macklin's been giving speeches saying, there's some headwinds coming. Looking at the data coming in for Canada, it's been better than expected, but you know what? I'm largely ignoring it because it's not really telling us where we're going. Sure, it's been better. And Tiff in this statement really pivoted quickly towards, the Canadian economy is proving to be a bit more resilient than we thought, but we have some headwinds coming. And I thought it was great, they released some of this sentiment data early, which is kind of off cycle that they normally wouldn't do, showing that businesses are planning on scaling back on investments, consumers are going to be cutting back. And so overall, I thought it was sort of this balanced view and the rate cut as we were expecting. And we do think we can get into this more. We think the Bank of Canada is going to lean more towards these recessionary risks and err on the side of cutting, despite the fact that tariffs do put some upward pressure on prices. We think they'll see through that as long as inflation expectations are anchored close to that 2% longer term. And actually, the sentiment data that they showed suggests, inflation expectations are higher in the short term, but if you look out past 2 years, they haven't moved that much. And I think that's something the Bank of Canada is going to be keeping a close eye on, because that will give them sort of license to cut deeper if they need to get in front of some of these trade.
Well, let's revisit that shortly. Yeah, I mean, I think from my perspective, I've heard it described as teacup in the world of sports. Athletes and teams are described as needing teacup, which is thinking clearly under pressure. And I think as a team, the Bank of Canada deserve a great amount of credit. They've shown real grace under fire, really. And I think what they've said, they've been very, very parsimonious, if you will, in discussing this. But when they have spoken, I think they've chosen their words very carefully. And I thought they maneuvered themselves very well today. I agree with you that release of consumer and business sentiment, which is basically taken throughout the month of February, was a stroke of genius because, as you say, they're guided by data. That's typically what they like to talk about. And I wanted to ask you about this. They like to talk about, when they can, forward guidance. Our new Prime Minister, Mark Carney, was sort of brought that in with the Bank of Canada when he was the governor. They love to talk about what they think it's going to look like and what they're going to do. And of course, they can't do any of those things. And the data they're seeing is the big data they're seeing is kind of irrelevant. So it's quite extraordinary situation they find themselves in. And I thought they did a really good job sort of, as you say, pivoting to, well, that's all fine, but look at this existential threat that we have, and we're acting upon what we're hearing about what that's doing right now. And so as a consequence, sort of no actual guidance per se, but it's fair to say from listening to what you just said, you feel like they're going to sort of lean towards the balance proposition, lean towards more cuts.
It was such an interesting statement today because on the one hand, you could see him celebrating, like saying, look, monetary policy is working. Inflation has come down. We're at target 2%. He's basically saying monetary policy is working. It's done its job. And so the inflation battle more or less has been won. And now we have a new battle. And so it was that quick pivot to saying, okay, let's pause and just pat ourselves on the back and say, we got this inflation problem most under control. And now we're entering new territory. And that territory is so uncertain that he didn't give a lot of forward guidance. He's basically the wait and see. We're going to look at the inflation data, see how it comes in. It's especially inflation expectations he's keeping a close eye on, which is interesting. What that tells me is that as long as those are anchored, longer term at 2, this is why I think they're going to lean towards cutting more. They're going to see through a temporary increase in inflation. They basically told us that that's what's coming. We're entering a stagflation type environment.
Yeah, actually, if I could just interrupt, sorry, because I wanted to make this point as well. Yeah, the very last sentence of their opening statement was, as always, the bank will be guided by our monetary policy framework and our commitment to maintain price stability over time. I thought that was quite telling as well, that they would leave you with that.
Yeah.
To your point around, if this is a short-term phenomena, we're going to ignore it.
Well, and they said, once the GST cut, the holiday comes off, we're going to see that in the data. Then inflation is going to go back to 2.5%, which might raise alarm bells. Say, wow, they've moved above target. But I don't see them overreacting to that. They have one eye on the core inflation readings, which are proving to be a bit sticky. But I also think they have to look at shelter, because shelter costs are moderating. You're getting less coming from rent. Of course, you're going to see the mortgage interest costs continue to fall as they cut. So overall, I think we're entering this trade war in good inflation shape. The economy not so great. I mean, the unemployment rate's elevated. GDP per capita hasn't performed particularly well. It's maybe turning around now, but at least on the inflation front, they can take some comfort. At least they're entering this in pretty good shape.
Yeah, and I think for me, I think the way I would probably summarize it is that they did certainly talk in terms of this being a crisis of some form. This isn't, this is not a normal situation that we find ourselves. The economy isn't unfolding as you would expect an economy to do based on monetary conditions and financial conditions and that kind of thing. Something else is happening here, a bit like the global financial crisis, a bit like the pandemic, in the sense that it's existential, and it doesn't really follow the normal economic rules that central banks would love to sort of follow, right? So to me, that sort of suggested that, as you say, they were sort of trying to look through the inflation to some extent, because ultimately, and it's very hard for them to say at this very early stage, A, it's very early in any process of a downturn anyway, and B, most of these tariffs still haven't even gone into effect. They're just continually threatened. And it's the threat that's slowing things down and creating fear in investment and spending. And so, they could look at it like, well, we could get a tweet tomorrow and all this goes away. I mean, it probably won't go away, completely, but a lot of it. So it's very tricky for them to be very definitive. And they certainly have done well to be sort of to dance around it. But the reality is, if everything pans out as they fear, the existential threat is not inflation. It's same as the pandemic. It's not inflation, right? So they're obviously going to try to do everything they can in that scenario to say, well, we haven't seen evidence this is going to stick around. We're much more worried about the fact the unemployment rate might be 7.5% before you know it.
Exactly. And I think what they're trying to do, I agree with that. They got the wording in the statement right at the press conference. Like, what they're doing is saying, look, we're going to do our job. We'll make sure that, inflation over time is 2%. Okay, so don't worry about that. That's important for people believing that, that they don't have to get, change their mind on inflation being like 4 or 5% 3 years out. It's like, no, we're going to get through this and we're going to be anchored at 2%. Don't worry about that. I think they're just sending that really strong message. But what he's also saying is, there's only so much I can do, right? Yes. Like, he's pulling that monetary policy lever. And I can't remember a time the Bank Canada's talked so much about the limits of monetary policy. Like, in the speeches in February, Macklin says, we have to, I can't remember the exact wording, but like, not expect so much.
Yeah, I thought I made the comment, I think, on our webinar that I sort of likened this to what I thought. Well, we hadn't heard from them yet, but I thought what we would hear today, and I guess a blind squirrel finds an application. I was right on this one. Uh, they would sort of take a similar approach to how they viewed the productivity argument or the lack thereof productivity, where it's like, we can help the general economic conditions of the economy, but rates can do nothing about productivity, the same way that rates can't solve a supply line issue from a tariff war. You can't, there's only we can help out in the biggest scheme of things. But I think the way I put it in the webinar was, we can be a crutch, but we can't be the crutch. This is something that needs to be solved by policy and by whether it be regulation between the governments, or indeed by fiscal policy if we need a package of some description.
Exactly. And I think this predates Trump 2.0. Like, they've been talking about productivity, how structurally we need to improve things in the Canadian economy for a long time. I mean, the famous Carolyn Rogers speech on, break the glass on productivity crisis, which some would argue,
and that was very, I thought that was a very, quite aggressive in tone, that speech, really. I was somewhat taken aback.
And some people said, ooh, aren't they drifting from their mandate? Like, should they be talking about this? And I would argue, well, look, if you have the combination of weak productivity and high wage pressures, which we've had, that's inflationary. So that's their problem. Now, can they fix the productivity crisis? No, of course not. And what you're hearing is them talking about interprovincial trade barriers and the need to boost business investment and all these things, which is like, why is the Bank of Canada talking about that? Well, what I think they see is, the solution to this trade war, and again, predates the trade war, but it's revealed itself even more clearly today, is that we need to improve some of those underpinnings of the Canadian economy. We need to, get businesses investing here, improve competitiveness, knock down these internal trade barriers, build transportation infrastructure, access overseas markets, all the things we've been talking about for a long time, but now it's gone to emergency.
Yeah, and all they can do is keep the cost of capital down as appropriate to fund those sorts of investments, those sorts of projects, particularly when they see business investment dropping possibly double digits from already low levels as a result of a prolonged trade war, right? Which is kind of what was in their forecasts from before. So the market thinks that, despite their protestations that there's only so much they can do, the market, which is I think we both agree are perfectly valid. The market thinks that they're probably going to cut another 2 times, down to about 2.25. And we went there initially, immediately after the tariffs were announced, and then sort of backed away because the tariffs were postponed. And now the market's kind of been there for about a week or so, since it was pretty obvious that this is not a problem that's going away. Do you think that's fair? Is there a risk? If there's a risk to that forecast, is it to the downside, do you think? Do you think maybe more might be required?
Well, look, it's like anything else these days. It's so scenario dependent. And I think what the market's trying to do is find where are we going to land with tariffs? We don't know. That's what the market's pricing it today. We've been running scenarios, say okay, if these tariffs last well into next year, we're in a really weak growth environment. Do we think the Bank of Canada would have to cut even further than what the market's saying? I don't think it's out of the question to think that we could be, if this trade war doesn't go away and it even escalates, that we could be at 1.5% policy rate early next year. So dip below sort of that neutral rate. It's interesting that the Bank of Canada now thinks that we could be at, that the market thinks the Bank of Canada could be at 2.25 by the end of the year, roughly, because that's the low end of their neutral, the Bank of Canada's estimate of the neutral range.
Well, I think that what people are starting to talk about is that we need to move into somewhat stimulatory, sort of stimulative levels, if you will, from sort of fairly neutral policy setting. I think 275-ish, 250 is sort of seen as a relatively neutral setting in a normal economy.
In a normal economy, but don't you think the Bank of Canada can dip below that sort of normal neutral rate for a period?
Yeah,
and then swing back up.
Yeah, I must be honest with you. I'm a little bit surprised the market hasn't reacted further. Not today, because we didn't hear anything today that was particularly in itself dovish. Like, it was pretty balanced with a dovish tinge, I think, which we sort of expected because, as I say, this is very early. And really what they're doing is setting out their stall of sort of like, if this happens, then we will view it this way, probably thinking it's likely to happen, assuming that a tariff war continues and these problems do not go away. But it's too early to make that judgment call. And given that they've eased as much as they already have, not only absolutely, but relative to the US, they probably feel they've got a bit of time to be patient and kind of explain their thinking. And I think that's real. But if the rhetoric ramps up and we get those tariffs in April and we get reciprocal tariffs because of, tariffs that we've put on, whether it be electricity or whatever it might be, right? Whatever we decide to do in reaction. I wonder if that's sort of I wonder if we get a sort of a tumble effect, if you will, in the market to sort of say, oh, in that scenario, then we need more.
Yeah, and I wanted to ask you is whether the market sort of pricing in the U.S. Federal Reserve is going to maybe have to move more than before. Like the talk earlier in the year was, well, they're going to be on hold forever because resilient economy, the U.S. exceptionalism is going to just keep roaring.
Yeah.
Inflation's sticky around 3%. We're down 2%. So it's got this rate divergence. Has that story changed? Like, and if it has, then doesn't that take some pressure off the Bank of Canada, not having to worry about at least rate divergence, putting downward pressure on the Canadian dollar and fueling inflation in Canada?
Yes, it absolutely does. And you're right. I mean, I can recall in the early part of January reading a very well-regarded analyst saying that they thought the next move in 2025 in rates in the US would be up. Now, they've sort of gone missing late, but they couldn't possibly have known that this was going to happen. So you're right. That's kind of where we were. The market was very comfortable. And indeed, the Fed even said at their meeting in January, we're minded to put rates down as long as inflation moves towards 2% over time. But they haven't seen enough evidence that that's a path that it's continuing to be on. So they were quite happy to sit back and say, hey, we've done all we can for now. And we'll see where it goes. And then obviously at that point, the market started thinking, well, what does that look like? And the reality, we ended up with this sort of compromise pricing where we had 25 basis points priced in over the balance of the year, which I don't think anyone really ever believed, because we were either going to get nothing or we were probably going to get more than that, because inflation would have to drift towards 2%, which would mean we'd get more. So that's sort of where we were. Now we have the market thinking the Fed are going to cut 3 times now over the course of the year. So the Bank of Canada has gone once today, and the market now thinks another 2 to 2.25. So essentially, the market is thinking that the Bank of Canada won't out-ease the Fed in 2025. And the reason why the US pricing has changed is what the market is considering to be the death of US exceptionalism. In 2024, the market grossly overestimated in the middle of the year how much the Fed would cut. And the reason was everybody thought, well, 5% rates surely at some point will bite and the economy will slow and the unemployment rate will rise and the Fed will be forced to cut rates, not maybe to the same extent as the Bank of Canada, but certainly to some extent. And of course, they did cut a little bit, but they stopped cutting fairly quickly because it was obvious that the economy was actually maintaining a decent amount of strength. The unemployment rate was not rising. And as a result, inflation sort of bottomed out. And actually, on a 6-month rolling basis, core inflation is actually started going back up again. So the Fed, as we just said, the Fed kind of put the brakes on rate cuts at 4%. So, and the story became known as US exceptionalism. The US economy is behaving so much better with rates, at 5% for almost a year and still at 4% than any other economy in the world can do at a lower level of policy setting. That's all gone. The disruption that we're seeing through the uncertainty around trade and the markets reacting to that, we've seen equities get hammered. We've seen the US dollar get hammered. We've seen volatility indexes like the VIX rise. And we've seen the market and we've seen bonds rally. And we've seen the market start to price in the fact the Fed are going to have to react to what looks like, if not a recession, certainly an extended slowdown as a result of the same uncertainty that Canadians are feeling. Americans are feeling it too. American businesses are feeling it. American consumers are feeling it. CEOs are feeling it. all of the sort of survey data that's been coming through, the sort of stuff that we saw from the Bank of Canada today has been coming through in various dribs and drabs in the US over the last 3 or 4 weeks. And that's all been very, very weak, looking very similar to what the Bank of Canada is saying about the Canadian consumer and the Canadian business environment. And so the market now thinks that this is as much a US problem as it is a Canadian one. So, which is kind of interesting. So yes, you're right. Given that we don't actually think the Bank of Canada is going to out-ease the Fed, and the Fed may actually come on board, while that analysis sort of holds, and that belief holds, the Bank of Canada definitely has an opportunity to be much more aggressive than the market thinks if it needs to. The question is, will it hold? We have the Fed next week. My guess is they'll try to talk through this a little bit. Bear in mind, this is quite political there. Here, this has been thrust upon us. There, this is their president doing this. And they've not exactly been happy bedfellows in the past. So my guess is they are probably going to want to punt this as far as they possibly can for 6 weeks. Nobody's expecting them to cut rates next week, so that's not really a pressure. We're expecting a 25 basis point cut sometime before the summer. So the pressure on them to act or sound like they're going to act isn't that great. So my guess is they're going to want to sort of talk about the balance against your point around, well, tariffs are inflationary, but they're going to probably hurt growth. And we're seeing sentiment fall and sort of dance around that. I don't think the market will back away from its expectations as a result, but I don't think, much like the Bank of Canada today, they're not going to give the market an absolute sort of green light to run with the idea that the Fed are going to be easing aggressively anytime soon. But if the sentiment numbers continue and we start to see business investment fall, and we start to see growth dwindle, they're going to be under the same pressure as the Bank of Canada.
Yeah. So President Trump might get the rate cuts he wants, but not the way he wanted it to unfold.
Well, it's interesting.
Market declining, maybe potential recession.
Yeah.
I don't know if you saw the first quarter. I mean, a lot of attention now is on the Atlanta Feds.
Yeah.
Now tracking negatives. There's a lot of economists say, well, it's might not work out this time, but the bottom line is you're going to see a growth slow down based on all the indicators.
Yeah.
And so, President Trump wanted these rate cuts. I just don't know if this was what he envisioned.
Well, without getting into the weeds too much, and I think you're right. If you look at the Bank of Canada's forecasts around a prolonged trade war, the reduction in output from previous forecasts was actually what they said. And so a point I think you made in the piece that you wrote today is, based on those outcomes, if they prove to be prescient, then growth in Canada is going to be basically zero. And I think what the Atlanta numbers are saying to the Fed in terms of the early indications for US growth right now in Q1, I would argue that probably it's similar. So sort of 2 and change % growth is yesterday's story in both these economies right now, based on the sort of what we're hearing. Which kind of feels right? I mean, it kind of feels like we're just going nowhere fast with fear and stasis. So, but interestingly, just on that, I don't want to get in the weeds too much, but President Trump has talked about lower rates, but actually he's pivoted to say that he wants lower bond rates. He's not that bothered about what the Fed do. But ironically, if the Fed were to react and slash rates aggressively, longer end bond rates might not come down quite so much. Actually, they might do him a favor by holding rates steady, letting the economy weaken a little bit, because actually the curve would invert further, and the bond rates that President Trump kind of feels are more relevant to business, and he's kind of right, are more likely to come down in that scenario than if the Fed were to act quickly and aggressively on data that hasn't fully formed. So there may be another reason why neither Trump nor the Fed would be that concerned about the Fed being patient.
Yeah.
Which kind of puts a bit of pressure on the Bank of Canada, but I'm not sure we're not there yet. Sorry.
What I find is really interesting because central banks tend to be really data dependent. And we're looking at it. But we're in this interesting point where the data doesn't really matter. Actually, the data can kind of misleading in to say, like, to the extent stockpiling's happening, you're getting this temporary jump in exports from Canada, imports from the US. You kind of have to see through that. And like we talked about earlier, is like I really like how they're using that sentiment data because leading indicators of what's going to happen. But really, we're shifting away from current analysis. Like the jobs report last week I don't even, like, hardly anyone looked at it.
Yeah.
I barely could get myself up at 6:30 to analyze it because I was just like, who cares about February jobs?
Occupational hazard for me, I'm afraid.
Yeah,
And I think
it's just so, and even the first few months of this chart, you can't read too much into it either. So
no.
really, like, the forecasts are so uncertain. Everyone's running these scenarios, but at the same time, they matter more than ever.
Well, and I think that, and that's what we were saying earlier, right? Which is, you're absolutely right. And I think what we were saying earlier was, again, I thought the bank did a great job in sort of framing this like a mini crisis. And again, so we're focusing on what's the existential threat here. Like, if things go wrong to the maximum of our concern level, should we say, what does that actually look like? And the reality is, it might look like inflation above the band, but it's going to look like a recession. Is what it's going to look like, even with, and I don't think, whilst they have an inflation mandate and they won't be happy about inflation above 3%, if that's where it is, or in the high twos, I just don't see in this environment how they could ignore negative growth. So I think what they did quite well was sort of suggest, look, there are many things that can happen as a result of this uncertainty, but ultimately, probably the biggest concern is growth and activity, and a lack of we might not even see that much in the way of job losses, although I do think that the news that came out the other day around what the US may try to do to the Canadian auto industry in Ontario, which is 150,000 jobs right there, I do think those things kind of probably do resonate a little bit. But I do think, and Friday's numbers would have borne this out, as much as we didn't really pay attention to them, there is very little job growth right now, but the workforce is growing still. So the unemployment rate is going to rise. This economy is going to look weaker, even if we don't get job losses. And we're not going to get the kind of growth that's going to do anything to offset that. So, in that scenario, what are they more minded to deal with? And I think in that respect, they can sort of sift through the data and pick and choose what they kind of want pragmatically, which, frankly, I don't blame them, because they're operating in a world. I think you summed it up. They like to be data driven, and they like to sort of have a model they can plug stuff into and say, well, this is what we kind of project, and so therefore we are doing this. But they don't have any of that right now. And I to go back to our original point, maybe to wrap up, I think they need to be really heavily commended for what they did today, because in the circumstances, I thought they made a good decision. I think they justified it. I thought they put some framework around it that you can understand. They didn't panic anyone. I mean, the bond markets moved 3 or 4 basis points, which in the circumstances is a job well done, I think.
Yeah.
Would you concur?
Oh yeah, I agree. And like I said, we have the task right now at my shop. It's like trying to forecast in this environment. And what they've done is they put out sort of, if they're under no tariff scenario in the January NPR, but then they quickly showed an illustration. If it does happen, this is what impacts you. And then those have been updated with the executive order that's come in with the 10% energy, 25% other. So I think the bank has done a really good job of kind of keeping we're along for the ride. And so we don't have to wait several months to be like, oh, what are they going to say now? We know where they stand as of today, and they've done a good communications job. I agree.
And and plot twist to end, they're dealing with a new prime minister, probably an election coming, I would imagine, and it happens to be an ex-colleague of Governor Macklem. So you couldn't write this stuff. There's so many balls in the air right now.
It's so interesting.
It really is.
And I know they're supposed to be separate, but I wonder how much Mark Carney's going to be trying to hold back at any time he wants to opine on this type.
Well, I do think if you consider the way he reacted to Brexit when he was Bank of England governor, I think he would have loved to have his hands on the fiscal button. Back then.
Yeah. So there he does, right?
He
can talk about that. Anyway, this has been really good.
Yeah, it's been great. Thank you for your time. Thank you, as always, to all of you for tuning in. We really appreciate your time and your attention and your business. And we remain here for you, both the economics department and the financial markets department, for any questions you may have or any business requirements you may have. And hopefully you've had a good day and you continue to enjoy one. So all the best. Bye-bye now.